Most traders think their problem is the strategy, but in reality, their real problem is the way they think and feel while trading. Mark Douglas showed that consistent success comes from mastering your mindset, not from finding a perfect setup. This short ebook will give you 5 practical rules to fix your edge from the inside out, so you can trade with confidence, discipline, and emotional control, inspired by the principles of Mark Douglas.
Rule 1. Accept that anything can happen on any trade, no matter how perfect the setup looks. News events, big players, and hidden orders can change the market instantly, and you will never see all the information behind a move. When you accept that anything can happen, you stop fighting the market and start flowing with it instead of trying to control it. Most traders say they accept risk, but emotionally, they still expect the market to do what they want. When the market goes against them, they feel shock, anger, or betrayal, because deep inside, they believed they knew what would happen. A professional trader accepts in advance that this trade can be a winner or a loser, and is at peace with both possibilities. Your job is not to force the market to match your prediction. Your job is to read the information, execute your plan, and let probabilities play out over many trades.
Rule 2. Think in probabilities, not certainties. A consistent trader thinks in probabilities, not in certainties. An edge never guarantees a result. It only gives you a higher probability of one thing happening over another. This means any single trade is meaningless by itself, but a series of trades, executed with discipline, can produce consistent profits. Imagine a setup that wins 60% of the time. You can still have a streak of 4 or 5 losses in a row, and the edge is still valid. If you judge your system based on 1 or 2 trades, you will constantly change rules, systems, and timeframes, destroying your consistency. When you truly think in probabilities, you treat each trade as just one event in a much larger sample size.
This mindset removes emotional pressure from each individual trade. You stop asking, "Will this trade win?" and start asking, "Did I execute my edge correctly?" Over time, this shift is what separates a professional trader from a gambler. Rule 3. Redefine your relationship with risk and money. Most traders attach their identity, self-worth, and survival to the outcome of a trade. When money carries heavy emotional meaning, every tick becomes painful, and you cannot think clearly. Real acceptance of risk is emotional, not just intellectual. You know you have accepted the risk when you can take a loss without emotional disturbance.
Professional traders think in terms of predefined risk units, not emotional amounts of money. Before entering a trade, they decide exactly how much they are willing to lose and accept it completely. Once they are in the trade, the money is already spent mentally, so there is no need to move stops, pray, or hope. Your goal is to see money in trading as measurement, not as identity. Profits and losses are feedback about how well you executed your edge and followed your plan, not a reflection of your value as a person. Professional traders think in terms of predefined risk units, not emotional amounts of money. Before entering a trade, they decide exactly how much they are willing to lose and accept it completely. Once they are in the trade, the money is already spent mentally, so there is no need to move stops, pray, or hope. Your goal is to see money in trading as measurement, not as identity. Profits and losses are feedback about how well you executed your edge and followed your plan, not a reflection of your value as a person.
Rule 4. Trust and execute your edge without hesitation. An edge only has power if you actually execute it. Many traders understand their setups, but still hesitate, skip trades, or enter too late because of fear. Others do the opposite. They enter impulsively on low-quality setups that do not match their rules. Consistent traders act on their edges without reservation or hesitation once their conditions are met. This is only possible when you combine three things: a clear set of rules, proof that your rules have a statistical edge, and emotional acceptance of the risk. When all three are in place, execution becomes almost mechanical and calm.
Think of yourself as the operator of a trading system, not a fortune teller. Your job is to follow your plan, trade after trade, the same way, regardless of whether the last trade was a win or a loss. Rule 5. Embrace losses and randomness as part of the game. Losses are not the enemy. They are part of the cost of doing business as a trader. There is a random distribution between wins and losses for any given edge, even if that edge is profitable over time. When you resist this randomness, you create psychological pain and start breaking your own rules.
Professional traders do not take losses personally. They see them as normal events inside a long series of trades, just like a store owner sees some days with low sales. Because they accept that every moment in the market is unique, they do not carry emotional baggage from the last trade into the next one. When you truly embrace losses as part of the game, several things change. You stop revenge trading, you stop increasing risk after a loss, and you stop needing to make it back immediately. Instead, you simply return to your plan and let your edge work over time. Closing chapter. Your real edge is your mindset.
Your real edge is not only your strategy, but the way you think about the market, risk, and yourself. Anything can happen. You do not need to know what will happen next. Wins and losses are randomly distributed. An edge is only a higher probability, and every moment is unique. When you internalize these truths, trading becomes less emotional, more consistent, and ultimately more profitable. Use these 5 rules as a daily checklist for your own trading. If you feel fear, hesitation, or frustration, it usually means one of these principles has not been fully accepted at the emotional level. Return to them again and again until thinking in probabilities becomes your natural way of approaching the market.